All right. Good morning, everybody. So here is your spot gamma levels for today. It's the SPX and the ES. There's the SPY, QQQ, and the NQ. Grab a screenshot and build those out. Also, I don't mention it enough, but there are pivots that are provided by Tier 1 Alpha. They'll come in an email. It's free. They'll give you a morning report, kind of give you an idea of what they see happening behind the scenes in the options market. There's a lot of times, especially in this 0-day environment, where the day-to-day options activity is actually driving the market. It gives us pinpoints. Really interesting how price will gravitate and pin to a particular level, and it's free, right? They don't spam your email. They don't try to get you to buy anything. And there are YouTube videos that kind of explain what's in the email. I've had people say, yeah, I get the email, but I don't understand any of it. Go to Google, go to YouTube. There are videos out there that explain it. And what you get from Tier 1 Alpha also covers major equities like Apple, Microsoft. It covers the sectors, so XLK, XLE, and it covers the indexes. So, I mean, it's a well-rounded, very powerful email for free. I like free. Free's good. Today, it's the first tier on jobs. And then we're going to get some business data. We got a lot of Fed speakers, home sales. So it's a wide swath. And Walmart is reporting today. That's a big deal. The size of the people that they employ, right? The number of employees that they have, and how much insight they provide to the lower and middle class economy. And whatever they come out and talk about, not just the numbers that they're going to provide, but what they come out and say after they come out with those numbers. Walmart is one of those companies that can absolutely move this market. So you really want to pay attention to what's going on with those numbers, right? We had kind of a little bit of a sneak preview with Home Depot and Target, but Walmart still won, right? And it's not because of their market cap. It's just because of the weight of their words. So 8:30, 10 o'clock, 11:30, and 1 o'clock. Those are your time frames for economic events. And then we have speakers at 9, 9:30, and 10 between Jefferson, Barr, and Logan. Not even including what's going on with Bank of England. You know, they're over there chipping teeth. And we've got a powerhouse for today. Yesterday morning, I pointed out that really powerful spike in the call premiums across the entire marketplace. It was the green line, big spike, wasn't necessarily hard to miss. And when I put the history back on 5 days, I was able to show another example where we had the same situation before, where there was this really big spike in green. And the idea was that the next day there would be a rally. We've seen that before. It proved itself again yesterday. Maybe the rally was a little stronger than anticipated, but we kind of had the idea that it was going to be a rug pull with a dip and a rip. And that's what we got. But yesterday afternoon, we started to get the opposite side. right? So if I turn SPY's price off, turn these calls off, get rid of the algo flow, there's your put side. Now, this is a couple days. So, just to hone it down into only yesterday, that's yesterday afternoon. These spikes in the puts started to come right around the time where the market topped out, turned around, and started heading back to the downside. It was around 2 o'clock yesterday. And we can see that because if I turn the white line back on, that's SPY's price yesterday. You can see where we topped out yesterday afternoon, started to fade back out again. And through that fade back out, there's a dashed dotted line here. That is support. That's where we stopped fading. Now, these two lines don't see each other, right? SPY's price doesn't see the cumulative market options premium. So it doesn't fall down and hit the red line. The red line doesn't interact with the white line. They're completely opposite tools. They're just overlaid on top of each other. But these spikes kind of imply that we might see the same thing as yesterday, but in reverse. I say might imply, right? Yesterday, we had, not yesterday, the day before yesterday, we had the market sell off really fast, and yet call buying was picking up. Call buying increased ×4, and price was still going down, implying that the next day, yesterday, we might get that bounce and rip. Well, it was calls being bought when price was falling. This is puts being bought as price is falling. That's two different things. The only thing that is the similar aspect that I wanted to point out is we had those spikes in the call premiums, and then we had the rip in the market. Here we've got a spike in put premiums. We could get a drop in the market. These are just windows, right? To look inside the premium options world and get a glimpse of what's going on in there. They're not promises or a roadmap or triggers to take a trade or anything like that, right? We're just trying to get some insight into what's going on across all of the marketplace. These aren't SPY's options that we're talking about. It's all options in the options market. So something to think about with these spikes yesterday. We went from, rolling at around a 5 or an 8 to ending the day at around 43. So an exponential increase in put premiums. And just to, kind of show the call premiums here, they really dropped off at 2 o'clock yesterday and faded down nicely. So yeah, a little something to be aware of, right? It could, yeah, it could be a sign of a reversal. The market really buoyed yesterday on just the hint that there was going to be a resolution to this debt crisis. A hint, that's all it took. So since nothing fundamentally changed, like when Boeing had airplanes falling out of the sky and wiping entire families off the face of the earth, their stock went down. And that makes sense. They had some serious issues. But the market has gone up and down over the last 2 days because they feel like we might get something done. So nothing's fundamentally changed. We didn't accomplish anything. Nothing's been signed. Nothing's been passed into law. They haven't accomplished anything. But the market feels like we've made progress. So that can easily change really fast. Go back to the Boeing analogy. They had to prove consistently that there was nothing wrong with their airplanes before things finally started to change again. With what we're talking about right here, all the market's got to do is get a little salty and not feel happy about the situation, and down we're going to go again. Or they resolve it and we really get out of this range that we've been screwing around in for weeks and weeks. Right? We've been in here since what, 4-2, and here we are 5-18. So, if they resolve this debt crisis situation, we could finally leg up out of here. The problem is there's just so much premium now on each side of this range that no matter which direction we break through, it's very likely going to take at least a first touch rejection, at least one. Right? So we break out the top, or we're very likely going to get smacked back down. Break out the bottom, get popped right back up. But with a big enough catalyst, we'll break through whatever side and then rip. Just got to see it play out. The old t-shirt still fits. I don't care where it goes. It just can't stay here, right? So at some point we're going to GTFO, but I don't think it'll be today. We are primed now this morning for one of my more fun trades. It's when we set a pre-market high and then we pull off of that high as we come into the open and we run up and retest that Globex high. I love that trade. It's not always easy to catch, but most of the time it is. Just set alerts anywhere near that high, go about your business, do whatever you want to do. And when price gets up there, triggers the alerts. You come in, you already have a plan because you already, had considered the idea that we were going to retest that high and fail. It can happen first thing in the morning. It can happen halfway through the day, but that's a great trade. So we're primed for that one this morning. We've set a high and we've pulled back off of it, but we do have econ, right? And that can really shake things up. FX Street does a good job of giving you a gauge on the anticipated impact of whatever economic event is on the books for the day. And you can see we don't really have one of those deep, dark, fully solid orange bars like we do down here for tomorrow. We don't have one of those today, but each one of these are enough. So I don't think it's going to be like a CPI kind of move. And this isn't non-farm payrolls. So, it's not like second tier job data, just initial jobless claims and, the fluffier side of unemployment data, jobs data. So we're going to expect a little bit of volatility, a little bit of moving around, and then very likely just going to settle right back into place again, unless it misses drastically, right? That 264, if you go to stockcharts.com and you go through their public charts, they have some really great charts on this unemployment. And one of the lines in the sand is that 264. But we get above that and things start to unravel a little bit. The consensus for this week is 254. So we could get some numbers that kind of shake things up. I have to see how far off the mark they are on that consensus. It's surprises that move the market, right? If all the analysts are on spot and they and everybody's set, we don't really get much of a move, especially if they all try to price in a big move. Then we really won't get a big move. 8:30, 10 o'clock, 10:30, 11, 11:30, 1 o'clock. It's a full house all day. So with this kind of backdrop, we're more likely to not get some kind of rip-roaring move. Each one of these could counteract the other one, right? Some of this data could be bullish, and then some could be bearish, and then some could be neutral or bullish again. So unless one theme really dominates the narrative, it's very likely that we're going to have more of a sideways day, a little bit of digestion from yesterday's move. Still keeping our eye on any sort of debt ceiling crisis resolution. We did have a beautiful TRB setup yesterday. Really was a little grumpy with myself for not pointing that out. So just to back up what it looked like yesterday morning. That's a TRB setup, trendline breakover. The idea is when you get one of these, that the candle that you get very likely will make it to the top of the range. And that can be 4 and even 5 times the size of the bars to the left. This one's not, right? It's not really that much bigger than the control bar, but it did make it to the top of the range, giving us a roadmap once it really started to break out and go. Where the hell are we going? Oh, to the top of that range. We overshot it, no problem. We went another 5 points, but it wasn't hard to figure out where we were going, right? Having a destination for the market really makes trading the market a lot easier. The analogy that I use is if we were to go to the store and you take your car and I take my car, I don't really care what direction you go. I don't care what street you travel. I know where you're headed. I'll meet you at the store. The same thing with price. Trying to determine every little beep and bop and pull back and surge. Good luck with that. Having a really good roadmap on where the heck it's going, that changes the ball game. When I developed this strategy on the TRB, I had not yet come across the strat and his machine gun pivot reversal strategy. Well, that's a mouthful. They really need to rename that. His logic is that when you get the breakout, well, first let's just start with all these wicks and the short traders. So if you went short this day, your stop was likely up here. And if you went short that way, your stop was there. If you went short that day, your stop was there. And of course, he's not really talking about futures in general. He's just more talking about traders. So, you know, on that day, maybe you didn't go short, but you didn't close your shorts. So you still had your stops from up there. And then if you went short that day, your stops were there. So then we get a breakout day and we trigger into those short traders with their stops. When you're short, your stop is a buy trigger, right? You buy to close a short trade. That fuels the buying, and we run into the next level of stops, which are also buy orders, which fuels the buying, and we run into the next level of stops, which are buy orders, and that fuels the buying. I didn't know that concept when I came up with my strategy. I just know that this is a really great setup. Nice follow through, by the way. Could have been a little better, but it was nice. The best plays form a lot better than that. That's a kind of a sloppy one. I've shown better, but you know, we take what we can get. The TRB happens on any time frame, daily, weekly, hourly, 15-minute, 1 minute, 30 seconds, doesn't matter. Most trading patterns that use price are fractal in nature, and that means they should work everywhere. If they don't, you might want to reconsider the strategy, because you shouldn't have to be on a particular chart just for that price pattern to work. Volume's a little light, but not concerning, since we already have an idea that there's a lot of economic stuff on the agenda today. If it was lighter, we'd have an expectation that the market was a little more concerned about the data that we're going to get. This isn't really much lighter than it was yesterday. So it's kind of implying the market's aware of the data that we're getting today, but it's not really concerned about the data that we're getting today. That can be a catalyst if they didn't deem the econ today to really be a threat and the numbers come in under consensus, over consensus, shocking numbers that missed the estimates and the market wasn't prepared for it, we'd get one heck of a move. So that's really something to consider. The ADR to the upside, half of it would take us up to 41.95. A full ADR would get us up to 42.20. That's based on a 21-day average of how far we've moved on a day-to-day basis. So I'm not reaching when I say that we could go to 42.20 today. That's a low ball estimate. To the downside, 41.46 is the ADR half, and 41.22 is the full ADR. That's a 100-point range between 42.20 and 41.20. That's the scope of our move today, and honestly, we could hit both sides today. That's totally on the table. We have an MDP also this morning, and MDP stands for missed daily pivot. We have a daily pivot point back here, and we have not hit it yet today. Markets generally hit their pivot 80% of the time or more. So when we don't hit that pivot, it should stand out. We're doing something in the 20th percentile, right? Kind of like when you say, yeah, you know, it always does this, except for the 20% of the time that it doesn't. We are extended a little bit beyond the weekly pivot point, not enough to be concerning. The weekly pivot this week is exactly where it was last week. And last week we hovered around that thing. As you can see, Thursday, Friday, Monday, Tuesday, and now finally Wednesday, we're beginning to expand beyond it farther than we have in a while. It's not the 10, so it's not exactly something that we have to gauge on that distance meter and try to decide, you know, have we moved too far, too fast? I would continue to use the 10 for something like that. There's that TRB setup. When we look at it on a 30-minute time frame, really looks nice. 10-day, 30-minute volume profile. When we're at the low, we expect to go to the high. When we're at the high, we expect to go to the low. We're at the high. Dun, da, da, da. Thanks, Captain Obvious. So we expect to go to the low. It's not a straight shot, won't make it in a day. This is a 10-day chart. It takes time to move from the high side to the low side. Keep in mind that phrase that I use, that will go from low to high and high to low, doesn't take into account that this entire indicator shifts and changes its location. The low that we have down here at 40.67 won't be the low tomorrow morning unless price today breaks that red box at 41.13. Because sometime today and in the overnight hours, all of this price is going to disappear from this grid. It's a 10-day grid. We will no longer have that, and it'll make this the low, maybe that, depending on what time come in for the morning briefing tomorrow. Right? So then using the phrase, you know, we're going to the lows would imply we're going back to 41.13, not 40.50. So just something to keep in mind. To try to wrap your head around this logic, there's a trick that I did to kind of help me better process this. So what I did is every day I took a picture of this screen right here. And I took the picture every single day at the same time, 7 o'clock. And if you look at the ES every day at 7 o'clock with this, and you start looking at where price is at and where these lines line up, you'll notice the change that I'm talking about. So, you know, kind of a little bit of a visual cue. This thing is dynamic, it is moving, but since I'm on a higher time frame, a 30-minute, we're not necessarily seeing it just on a moment-by-moment basis. And it really doesn't seem like it moves at all, but it does move. All right, so yesterday's point of control is up here, even though we really didn't spend much time up there. If I was to turn on a TPO it would show that the point of control is very likely still down here and not up here, because the TPO would say we spent more time there than we did up here. And that makes sense, right? Because if there's 22 hours in a trading period and only 8 of it is here, then we spent more time down here than we did up there. And yet, looking at a volume profile, we have more volume here than we did through all of this combined. Now, volume doesn't necessarily mean buying. This could have been profit taking. Kind of goes in with the idea that we stalled out there and didn't continue to go higher. But a lot of the institutions, they don't close trades. If they were long and they had this run up and they wanted to manage their position, they would just add shorts, not close longs. You want to wrap your head around that one, look at a COT report, commitment of traders. You can Google that. I've done videos on it. There's a lot of people's done videos on it. I recently did a Chat GPT video where I used it to research a COT report, just to kind of demonstrate that, you can have that little dude sitting right there next to you, teaching you all this economic stuff and trading stuff, like having your own little trade librarian. All right, so at this point, one of the things that we want to do is measure yesterday's really big move and mark out the midpoint. It's going to be really easy to remember because it's 41.50. It's one of the major levels in the options world. All right, so that one's a biggie. You basically want to call it a cog line. We won't, because cog lines mean something else, but this is a big one. You always want to keep that one on your S&P charts. 41.50, 4,200, 42.50, 4,100, 39.50. If you read the spot gamma reports or the tier 1 alpha reports, those levels are constantly being mentioned. It's put walls, call walls, vol premiums. It's a major level. It also happens to be yesterday's 50% level. So if we do fade to the downside, that's going to be the destination. It's going to be the target we want to aim for. And that would still give us a bounce point off of the 516 candle as well. That candle's high. Otherwise, looking at it on a little bit of a bigger picture, this is the range that we've been struggling with. $41.88 is going to be a level of concern over our head. 50% of that measured move will be 4,200, and 100% of this range will be 42.34. Notice the 50% level here lines up with this pivot point. That's not a coincidence. It's not a, oh, golly gee, look at that. It matches. When you draw your stuff in the right location, it will line up and validate other levels. When you draw your lines and they're sitting in the middle of nowhere and they don't line up with anything, you probably drew it wrong. $41.93 is the top of the weekly expected move. So for all of the week, starting with last Friday, how far we were supposed to go, or how far we were expected to go. Let's say it that way. That is a little more appropriate. Was a range high of 41.93. And that doesn't mean that we would just get there and stop, but it does imply with statistical accuracy that we will close inside of that box more than 70% of the time. One standard deviation, 70%. The S&P usually beats its standard deviation. So it does it more than 80% of the time, most of the time. And in fact, when it actually starts breaking down and not closing inside the box repeatedly, it's a warning. Missing once in a while, not a big deal. Start missing week after week, watch out. If you want an example of that, go back in the charts right before COVID. Look at January and February, how many times we missed right before the crash in February. We started to break outside of that box repeatedly. And then everything broke down. That green line there, 4165, that's a voodoo line. 4160 is the other one down here. I don't know enough about those voodoo lines to really give much insight on how they work. I just know where they are, and I absolutely pay attention to them. That was my target yesterday when we broke out and started that run to the upside. And you can see how well price responded to it after we did make it through there, gave us a Busby, paid us the Busby. And then later on the fade back, that's where it stopped, found support again. Pretty cool how these things work. I really struggle to trust them because I don't understand how they work. Also, they're provided by Simpler Trading. That's one of the few indicators I can't share because I didn't make it, and it's one of those private ones, so I can't share it. But you also have to go get new versions of it. It's like they're manually putting those lines in, which makes me not trust it even more. But or not necessarily not trust it, but I like it. I don't appreciate it because I don't understand how it works. But it is a line worth marking out, right? Even if you don't have the indicator yourself, that line's going to stay put for at least another month. They don't update the indicator like every week. And since we've been range bound for 2 months, they haven't updated the indicator for a while. NASDAQ as well. Oh, wait, that's US dollar Japan. Forgot I swapped that over there. A little more noisy here. We've got, the spot risk levels and the spot risk channels and the voodoo lines. So a little more noisy. But there is one at 13,692 and 13,600. You can see 13,600, we managed to get through it, but it was where we, paused, had to digest some of that move before finally moving on. All right, the moving yields is pretty obvious, not hard to miss what's going on over there. The idea, though, is we need this to kind of calm down a little bit. So if we use that R line, linear regression line, you can see the swings. They're starting to tighten up. So they started, pretty tight down here. We got an equal expansion on each side there. It got a little bigger. failed to reciprocate equally across right there and gave a retest. Smaller, equally measured move there. And now we're failing to get an equal move here. It's odd how it works, but if you get a 0.5% above the line here, you'll generally get a 0.5% down here. If you end up with a 1% here, then you'll usually get a 1% here. It tries to stay uniform. And so when it doesn't, if you get a good move on one side and then a stall and a matching move again and another stall, this is topping out. It's also a rising wedge, and rising wedges break to the downside. You can get a blow off top first and then a fall, but it's still a reversal candle pattern. And the measured move would put us at around 3.4. So it's not into that 3.3 level that we're worried about. As long as yields are above that 3.3, we're not going to see too much drama. But right now we're getting close to that 3.6. And above that, we could start to see some drama. So it's kind of this sweet spot we got to sit in, 3.6 to 3.3. We're nearing the edges of that sweet spot. So this needs to calm down, start that turnaround process of topping out, maybe a fade back down. Keep your eye on this thing today, because what we don't want to see is another move like Tuesday. Big sweeping candles, large expansions, breakouts, lots of push. That's not what we want, right? Yesterday wasn't much better. That big expansion, solid push. We want this thing to calm down. No big moves. Same thing with the dollar. We want this thing to calm down with no big moves. Bonds, as you would expect, the complete opposite. So we're going to be expecting bonds to turn around and stabilize, maybe, hold those lows and begin working their way back up. And we're going to expect yields to continue that fade back down, maybe a little topping out and fading back. Technology today is doing better than finance. Finance yesterday was doing better than tech. And we can see that with the VWAP. On the ES, we're almost in contact with it. We are nearly back to yesterday's high after this inside day breakout. But on the NASDAQ, we're still holding considerably away from the VWAP, and we're not yet falling back to yesterday's high. I mention that because if you go into, like the flex grid, you can see KRE this morning is moving around, but you can't see anything out of tech because we're using that NY FANG, and it won't show anything until 9:30. Now, I mentioned yesterday how maybe it was earlier in the week, I mention it frequently. If you only have one of these, then it's tech versus finance, or it's finance versus tech, right? Something like that. And we don't want one versus the other. We want them both. And when we get both, we get a really big move in the market. It was one more tell that yesterday was going to be one of those ripping breakout runs. So it was a half-day wedge breakout. So we already had the idea it was going to be a dip and a rip. Just didn't see that big of a rip. And, to be fair, we never know how far a market's going to rip. The closest thing we've got is that 0-day data that will pinpoint us towards one of those major gamma levels, right? Because it's going to be 0-day monetization of puts and options that just drive us like that. But seeing both of these work together, seeing the C-tick spread out like a fork, all pointing in the right direction with the green line leading to the upside, and very clear distribution between all three of these, that's a solid rally day. You just keep buying, right? So this morning we can see XLF financials, they're up a minor amount. My benchmark is 0.5%. So if it's not up that much, I don't even register it. So when we look at what's down this morning, nothing is down more than that 0.5% that I would use as my benchmark. Gold is down, not enough. Bitcoin down, not enough. Bonds down, not enough. Right? Emerging markets, not enough. So it takes us to the other side of the page. What's up this morning? What's that? So banks are up. We were just looking at the ES. It's weaker than the NASDAQ. Semiconductors are up. Regional banks are up. Those KWEB constituents, not enough. They're up, but they're not enough. And nat gas is up. All right, so Walmart's moving around a little bit. 154 is kind of that line to the upside. 148.5 to the downside. We're looking at 12 quarters of earnings here on Walmart. There's this pre-earnings ramp. Some analysts use a 21 days, some use an 8-day. There's no wrong number to use, but we got both here. Walmart's 21-day pre-earnings ramp is about 1.5%. So a $2.30 move on average in those 21 days leading up to earnings. That's where you get this green box on the left side of the earnings report. Or if they didn't make a run up, but instead faded down into earnings, then you have a red box on the left side. Then you have earnings itself, yellow, red, shades of yellow to red into green in the middle. And then on the right side, green or red, depending on if it was a good earnings or a bad earnings. There's the pre-run into earnings, and then there's the after earnings move, and then there's the earnings move itself. 3 different trade opportunities, depending on the kind of trader that you are. Maybe you do one, maybe you do all 3. Down at the bottom is the volatility, the anticipated move. So, just like everything else, it usually gets understated, then it gets overstated, then it gets understated. People, slip on this, think it won't be a big move. It gets a big blowout move. The next 3 earnings, you got everybody thinking it's going to be a big blowout move. It won't. It doesn't. They quit watching it, then you get another big blowout move. So we're on the lower end of that scale here. We just had earnings. We could see that the ramp up into earnings wasn't really all that much of a ramp at all, and is the lowest implied volatility reading going back a few years. So this is one of those sleepy times where everybody just kind of shrugs and says, whatever, it's Walmart. It's not like we're going to get a big move. At least that's what the options implied. And so far, it doesn't look like they're wrong. This isn't much of a move. Of course, I don't know what they're saying because I'm on here with you. But I did mention at the start of this briefing today, you want to know what they said. Take the time this weekend to, I don't know if you really need to like crawl through their reports and listen to it all, but find somebody who did crawl through the reports and read it all and listen to what they have to say. Obviously, if you can do it yourself, that's better. But I don't know. I always feel my weak spot is the fundamentals that I feel others can do it better. And so I generally, go to Seeking Alpha and Investors Business Daily and places like that, and I read what others have to say about it. But you're going to want to know what Walmart has to say because it will affect a lot of things going forward. So it's worth it, right? Even if you're a futures trader, this can have impact. So it's worth, kind of getting a little bit of an idea what's going on out there. So we're looking at 154. If it breaks through the 154, then we're very likely going to expand. We'll call it 158, first blush. $162 and then $171. Obviously not all in one day. So Tesla's up to 175 this morning. That puts us still inside of this big red candle. But we are inside day breakout. So we got, a really nice expansion yesterday. The fact that we're above the 50% line on this now needs to be the line in the sand, right? Don't want to see Tesla fall back down below that 172.31. It wouldn't surprise me if we stall out still inside this box. So, getting into that 177 area, and then that'd be about it. That's also last week's high, right? So we're talking about an inside week breakout. If we could actually get through that 177, I don't think we got it today. At least not with what we've seen so far. We'd need a real push. That's going to be a significant level of resistance. And the area to really kind of keep your eye on is that last wick area, right? That 176 up to 177. It's where all the liquidity is. If there's still big sellers up there, they're going to be waiting to sell more, right? Look at the close here and the open way up there. Think of all those trapped traders, all those suckers that bought right there. and you can bet they're still holding. Not all of them, right? There's people who know how to manage their money, but there's a lot of trap traders here. So if we do come back up there, those trap traders, they're going to sell. GTFO, they're going to sell, right? So there's a lot of liquidity up here. Just be aware of that. If we do get up there, it'll be a nice short, like a scalp, couple of scalps. We could still push through there. It's not like we can't get through there, but first touch play, maybe 2. It's going to take a little while to unwind that trap. We still have a gap to close at 180. So if we do get through there, we at least have a destination to aim for. Microsoft just continues to grind along in the background. That is a very sloppy rising wedge. And it did manage to get an inside day breakout yesterday. It's up again this morning, but not by very much. And it's still inside day. So it needs to complete that. Just getting an inside day breakout here would be awesome. And it would be a lot easier than yesterday. When you think about, closing way down here and then opening gapped up and then the loop-de-loop and then finally getting the breakout. It doesn't have all of that drama today since it closed here and so far is going to be opening really close to the high of yesterday. So that's breakout potential. The thing is, it's exactly like this. We closed near the high. We opened we closed, in the upper body. We opened it very close to the high, and then we had that really great rally and a pullback. I get it. I mean, that's one way it can go, but there's the other thing, right? The other thing would be where we close in the upper body. We open gapped up and down we go. So for a rug pull, that's a really nice setup. Looking at it on the weekly, even if we do fade back, it's very likely just digesting the move that it's already made here, and it is not bearish. Not even a little bit. There's nothing here that's bearish. So if you're shorting this thing, short duration, right? Friday's expiration, next Friday's expiration, that sort of thing. Get a couple points, GTFO. Same thing with Apple. Now, it's hard to read all this sideways activity and think anything other than bearish. But the fact that it hasn't fallen, that says a lot, right? So it is an island. It is gapped up. Can't argue with either one of those statements. But until it actually breaks that range and starts heading back to the downside, this is just consolidating after a really strong move. It's healthy. You want a market to do this if you're long and you're an investor, right? You don't want parabolic moves. That's bad. We closed at 172.69 and we're at 172.60. So we're right at the close. The thing is that close was in the upper body and it was near the high of the day after a really nice couple of days to the downside, and that is a TRP setup. Covered that earlier. You can just catch the replay. The idea is going to be that there is very likely stops at all those locations for short traders. And a trader who is short with a stop, that stop is a buy order. So if we start to rally to the upside today and we start triggering into those stops, it's going to add to the buying. which gets us into the next level of stops, which adds to the buying. It gets us into the next level of stops, and we can make it all the way back up to the top of the range in a single day, just like we did yesterday in SPY. Now, because a TRB is such a big candle, you don't have to get it early, right? Two kinds of traders: your confirmation style traders and your anticipatory traders. You would, as a new trader, probably think that waiting for confirmation is a better way to go. It's not better, it's not right, it's not wrong, good, bad. It really just comes down to how good you are with money management. At the end of the year, if you compare the two style of traders and they're both doing it effectively, they're going to make about the same amount of money. So if you wait for confirmation, you need this to actually break the yellow line, break above yesterday's high, and at least get above this doji. That would be a good start to a confirmation. If you're the anticipatory trader, you probably got in it yesterday, or you're going to just trigger into it as soon as we get the inside day breakout this morning. Again, it's not right or wrong, right? It's just whatever style you use and how good you are at managing your risk. Amazon closed at 115.5. It's at 116.3. We are inside day breakout again, since the high of yesterday was 115.83. So we're sitting above that line right now, somewhere up there. As it fades down this morning, it needs to test off of that and then run to the upside if you believe it's going to continue to be bullish. With Walmart, Walmart says the wrong thing and it could take this down. So it was supposed to be about Walmart's food, since they make more than half their money on food and they have an edge on, the food that they can get at cost. So if they also report really good sales on electronics and food and, show any sort of competition against Amazon, we could see a little bit of a fade here. On the other hand, if they say something the wrong way, it could just keep lifting Amazon to the upside, which is why I am suggesting we could continue to go up in Amazon today. But I got this sneaky suspicion we ain't gonna. So that 115.83 is kind of a line in the sand. Breaking that would be a heads up for a short, and then breaking that close of yesterday would absolutely be a trigger for a short, and destination would be that close, 113.42. We get inside of that, you can aim for 50%. Get inside of that and you can aim for the low of the day. Gets us down to like 111. Not bad from 116. So easy triggers, right? All we got to do is get back inside yesterday's candle and then break below the close of yesterday. If you look at the weekly, there is a little bit of concern on this right here. And this is one of the reasons I think we can continue to go up. If this was trapped traders, if this was liquidity that was holding us back, we've taken it out. It's gone. It's off the table. And that means the next level of any potential liquidity issue is going to be around that 120. And we could very easily go to 120 in Amazon. So really need to hear more about what Walmart had to say. Makes sense? Of course it does. NVIDIA has expanded really far this morning. And if there was ever a picture of a blow off top, it would look like that. That looks like a great short. We closed at 301.78. We're sitting at 305.10 at the very least. Getting back down to where we closed would be a good start. Be a little careful. It's not a classic Marbozu because there is a wick up there. But that's a very bullish close, and it managed to get through all of that liquidity, right? So if there was any trapped traders here, anybody who went long and managed to hold on for the pullback, the gapped up strong rally and the breakthrough, that's still really bullish. But going from 280 to 306 in a week, that's a huge move. Adding to this other really big move from back here, right? So big move, digestion, big move, digestion. So kind of anticipating a little bit of a fade. I'm not saying that this is going to be, you know, a short back down to $200. That's not what I'm talking about. But a short-term trade for Friday, or maybe even for next Friday, you would basically be trying to trade something that's going to look like that, or maybe something that looks a little bit like that, right? That you get this run up and you get a little bit of a digestion and you close that trade and look for another opportunity. You're not trying to run this thing all the way to the ground. The line in the sand will be pretty simple. Just mark out 50 and 100. And use that. All right, everybody, be careful, be safe. Watch the clock, watch the news. It's going to be the driver today. Very likely the debt ceiling talk will trump anything else. Really got to use another word. That one don't work. See y'all tomorrow.